Today, I'm doing a video about SPACs. If you guys have no idea what these are, you found the right video. This is SPACs 101 coming up. Welcome back, guys. Welcome back to the channel. My name is Sean. If you're new here, I talk about personal finance and investing topics. So if you're interested in that stuff, please consider subscribing to the channel. So we got a big one today. I'm going to get right to it. We're going to talk about SPACs today. SPACs are a special type of investment, a little bit riskier investment than traditional shares or stocks that we normally talk about on this channel. But I gotta give a shout out to my man Donnie Nguyen. He has a page called Wolves of Investing. It's got a YouTube channel. I'm gonna leave a link to it in the description because I got a lot of today's information from his channel. It's very educational, very well-researched videos too. So if you haven't checked him out, be sure to do so. So before we start, SPACs are special purpose acquisition companies. So if you hear me say that, that's what it stands for. We're gonna also be using an example today of a SPAC called AJAX, ticker AJAX. And that has kind of been getting some buzz lately because it's a SPAC that's kind of been formed by some celebrity sort of CEOs and stuff, but we'll get into that later. So if you hear me say those terms, those acronyms, that's what they are. So without further ado, let's go. All right, so again, what is a SPAC? So SPAC stands for Special Purpose Acquisition Company. And the goal of a SPAC is to actually eventually merge with another business. That could be doing a reorg or a reverse takeover, some kind of business combination, which is the term that is what is used when you describe a SPAC. It's an alternative way for that other business to go public rather than to go through the lengthy process of a traditional IPO onto the stock market. Now, you can invest in the SPAC itself, and we'll talk about this, but there's a big disclaimer here and a big one on this video too, because SPACs are generally riskier types of investments than traditional stocks. So you got to know that going in. This should be a smaller part of your portfolio if you're interested and really understand SPACs. So I just got to say that up front because these aren't kind of a traditional share. It's not, you can't go and analyze the company as easily as you could with another business that, you know, has financial statements and a bit of a history. So SPACs are kind of speculative that way. You really have to look at their S1 filing closely, and knowledge really is your best friend with anything risky, and the biggest thing you can research on a SPAC is actually the leadership team. So we'll get into that right away as well. So why even learn about SPACs? Well, like you, I had no idea what a SPAC was before last year, and then all of a sudden I hear about these companies like DraftKings and Nikola merging with a SPAC, and I'm like, well, what is that? And you start to hear all this buzz around the investing community. So the reason is because in 2020, almost $60 billion was raised via SPACs, and that wasn't the case any of the years before that. And so to understand why that was, you kind of have to understand the advantages of a business to merge with a SPAC rather than go through that traditional IPO process. So here's a couple of reasons, actually three. First one, IPOs are often lengthy and they cost money in the underwriting and all the paperwork. And don't forget that they also take a lot of marketing, like Airbnb was going around and marketing its business before it IPO'd, wanting to generate a little bit of that interest, that hype. The second thing is in a year like 2020, when we saw stock prices double after they go public, we saw that again with Airbnb. SPACs offer a better method of capturing that value of the company, and there's less of a lost opportunity. So what I mean there is actually, like, if you're the business owner and you decide you want to sell your shares at a certain price and you pick $70, and then your stock IPOs, and everyone buys up your stock at $70 and the stock jumps to $140. Well, now you're kind of thinking, I've missed out. I should have actually priced my stock higher. Well, with a SPAC, the deal is reached between the leadership team of the SPAC and the business owners, and everything is on the table. They know exactly how much money they're getting, and they receive the money that they think that their company is valued at. Now, here's the third reason. A SPAC offers a quicker and less rigorous kind of inspection process and just a faster way to get to your cash and get public. And in an uncertain year like 2020, where you weren't sure where you were going to be at in a few months, which is how long it might take for your company to traditionally go IPO, a SPAC is just really quick, and you know that you can get what you need before the market starts to shift or something else happens. So in 2020, you were constantly waiting after March for that stock market to decline, right? So companies would rather merge with a SPAC, get their money, get going, they're being traded publicly, get on with the rest of their life. And that's a lot quicker than maybe waiting a few months and not knowing what's going to happen with the stock market while they do all the underwriting and all that stuff. What if the stock market dips and then their IPO is not going to be successful? So all of this led to a really popular year for SPACs in 2020, and I think this trend will now kind of continue in 2021. So if that does, you may want to understand SPACs a little bit and how they work, because it may be an investment you're interested in and you want to try out. I should say personally, I don't hold more than like 5K in SPACs right now because I'm still learning. I thought I knew a little bit about them when I did invest, and actually when doing this video, I learned a lot more. So probably should have waited a little bit, but I'm just being transparent. So this has been a good experience for me as well. Okay, the way I'm gonna explain how a SPAC works is I'm gonna actually put up a kind of a timeline to sort of go through the different important events of a SPAC. So first thing you got to start off with though is the SPAC sponsor. So the manager of a SPAC is called a sponsor. And the sponsor may set up like a leadership team or a steering committee for the SPAC to guide the SPAC towards a goal of merging with a certain business. So this is why it's really important for a SPAC to have a good leadership team. You really want to research who is managing the SPAC, who's the sponsor, who's on the board of directors, and what are their connections. Are they successful CEOs? You kind of want to go back and see, oh, this is a CEO from a certain company. What did they do? You want to know what kind of connections they have, because that might give you a clue as to whether they can easily find that targeted business to merge with. Every SPAC has kind of like a business that they'll target in a certain industry. So if they have people on their board that are familiar with that industry, you have a good chance of some sort of business combination happening. Now the sponsor and or leadership team will also set up a trust fund that seeks to find that company and merge with them in a given time frame. And this may be investment money from the leadership team or other investors. All right, so in our example, we're using AJAX. So who's the leadership team there? We've got Daniel Och. He's the founder and former CEO of Och Capital Management. You have the president and director, who's Glenn Furman, co-founder and co-managing partner at MSD Capital. Then the board is comprised of Kevin Systrom, co-founder and former CEO of Instagram, and Wojcicki, sorry if I'm getting these names right, Wojcicki, I think, and Wojcicki, co-founder and CEO of 23andMe, and Square co-founder Jim McKelvey, and Steve Ells, founder and former CEO of Chipotle. So that's some pretty big CEOs there. A lot of kind of name dropping in that introduction, but that normally would give you a lot of confidence that this leadership team will be able to get something done, right? But it's not just enough to have like experienced CEOs, in my opinion. You should research a little bit deeper. See if these guys would have connections with people that are into the type of company that they're trying to merge with. And if they do, then you got a really good chance that a business combination will happen. So just a tip, because that's really the only research you can do. Go back to those companies, see what happened in that company while these people were CEOs, and if they were successful, that gives you some confidence that they're going to deliver on their promise here. Now let's get back to the timeline. So the next step is to actually have the SPAC IPO. So the SPAC files an S1, just like any company does when they IPO. And in the S1, they describe the goal of the SPAC and the type of company that they want to merge with. So they usually have 2 to 3 years to find a company. And the S1 also outlines other important info like the IPO price, unit to warrant ratios, and exercisable dates of warrants. Now, if you don't know what that means, especially this stuff about warrants, these are just important dates that you'll know, but I'll explain what they are in a bit here. Now, when the SPAC IPOs, they can now be traded on the stock exchange, or whichever stock exchange they choose, and they can be traded by the public and enter what is called their searching phase, which is just searching for that company. Typically, they trade around their IPO price for this phase. This is because the value of the company is worth just the amount of money that's in the trust. So the IPO price is in the S1 and it's usually around $10. That's what it is for AJAX. It's usually around $10. And really at this point, the company is just made of cash. It's a shell company, and this is why they call SPACs blank check companies. Now, after an IPO, the SPAC is trading units, which is made up of a share plus a warrant, or a fraction of a warrant. Again, we'll get into what warrants are a little bit later, but 52 days past the IPO, this is also stipulated in the S1, the units, shares, and warrants begin to trade separately. Okay, so now let me talk a little bit about warrants. So warrants give a holder the right to buy a specific stock at a specific price after it's exercisable. And this date, this exercisable date, is usually 30 days after the merger with that other company. That date is also stipulated in the S1. So again, more on warrants later, but what you need to know right now is that you may find units, shares, and warrants all being able to trade those and invest in. Also note that not every broker trades warrants. So if you're using Robinhood, they don't trade warrants. I believe you can only buy shares there. And also if you buy units, you would have to pay a fee to split those units up into shares and warrants, and you have to check with your broker for what that is. As an example, E-Trade charges you $38 for what's called a voluntary action, and that is to do that separation, and it takes a couple days. So I'm kind of getting ahead of myself, but next the SPAC will want to find a good company to merge with, right? Now let's say they can't find a company. Well, if they can't find a company within that time frame, they'll actually return all of the money back to shareholders plus some adjustments. So they might subtract management fees, but they'll also pay interest for how long they held that money. But everything would go back to those initial investors. But for the sake of our example, let's assume that a merger is found, okay? Now, around a merger, you will typically see some movement in the stock price. So if investors like the rumor of the merger, if they think it's going to be a good combination, you might see the stock price go up, but you can also see it go down. Nobody can really predict this. That's kind of what makes this speculative. Now, 30 days post-merger, as we discussed, you reach that exercisable date of the warrants. And this means you can redeem the warrants for shares at this date. Now, I really want to get into the warrants and redeeming warrants and the exercise fee and all that kind of stuff, but that's really a little bit more detail than this video. So I'm going to make another video about units, shares, and warrants. I'll link it up here and post it right after this, and once it's posted, I'll update the links and stuff. But that'll get more into the math of like when you want to pick a warrant over a share and that kind of thing. So this is just an overview. And then finally, at the end of the timeline, if a merger is reached, there's a bit of a timer put on exercising those warrants. And this brings us to the end of the timeline, and it's 5 years from the merger. On that date, the warrants kind of can expire worthless, but something else may happen before that time, and that would be early redemption clauses happening for those warrants. So in the S1, the company can stipulate that you have to redeem your warrants under certain conditions. So for AJAX, and these are typical conditions for most SPACs, it says if the stock trades for $18 or more for 20 out of 30 consecutive days, they'll send you a notice and kind of force you to go and try to redeem those warrants. And there's a couple types of redemption that can happen. One is called a cash redemption, which is where a company pays cash for the warrants. And while this raises money, it can sometimes dilute the shares. There's also another one called cashless redemption, which trades your warrants for shares or fraction of shares so that it doesn't dilute the shares as much, but no money is raised in that case. So that's an overview of kind of how a SPAC works, the important dates in the S1 that you should look for, and kind of the sequence of events of how things should roll out. But like I said, these are kind of more speculative plays. So what are some of the risks of SPACs? We got to talk about risks because they're more significant with SPACs. So consider these. One, this can still cost investors even if you don't find a merger or the SPAC is not successful. Some of these SPACs can guarantee managers like a certain percentage of the trust even if a merger isn't found. So it's something to be aware of. Second thing is that that time limit of 2 years or 3 years might sometimes put pressure on the sponsor to create a business combination that probably isn't the best for the company. They may just want to try to make a deal happen to kind of save their ass, basically. So there's a risk there that you may not merge with the best company because you're just trying to beat a timeline. Third reason is that since SPACs bypass some of those regulatory and legal hurdles, you may sometimes get companies that are a little bit shady. And SPACs historically, like SPACs are nothing new, but historically they have been kind of linked with maybe more fringe type of industries. I'm not going to get into what those are, but just something to be aware of. And finally, it's important to know that not all SPACs are always profitable, okay? So from January to July in 2020, they returned 13.1%, which is actually quite good if you think that like the S&P 500 is around 16%. But if you take away Nikola and DraftKings, just two of the biggest SPACs, then it's actually negative 10.5%. So these things work, but it's important to know that they don't always work, and probably the majority of the time they aren't as good of a return as maybe some of your index funds if you're just thinking of like setting it and forgetting it. So it's important to know that these things will require like a close eye. You want to keep an eye on them, and you don't want to just like set it and forget it like you would an index fund. Well guys, that's it. I hope you've learned a thing or two about SPACs. Like I said, I'm going to work on that warrants video right away here so that we get into the warrants and talking about like leverage and arbitrage and the certain conditions and opportunities that you'll look for when you trade warrants. But we'll get into that later. I hope you guys have enjoyed this. I hope it's brought some value. Until next time, have a great week, spread the wealth, and I'll see you in the next one. Bye.